The webinar will begin in 2 minutes. The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar, the C-Corp Tax Advantage. The webinar will last approximately 10 to 15 minutes, and at the end, we'll tell you how you may receive supporting materials by email. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sujas. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Limeberg, and he regularly speaks at industry events. His latest book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, which was written together with a CPA and a business broker, is now available for sale. Linus will draw on his legal, tax, and life insurance background and his practical experience for today's webinar. And here he is.
Thank you very much, Jennifer. Welcome, everyone. I hope everyone had a great 4th of July holiday. We're all back at work now, and I'm glad about that in some ways. I hope you are glad about it, too. We'll talk today about the C Corporation tax advantage. It should be a relatively short webinar. Before we get into the meat of it, though, let's talk about or decide on what we're going to talk about next month. Our next webinar will be on August 4th, and the three choices for next month are managing after-tax qualified money, captive insurance companies get a win, HSAs in a nutshell. Those are the three choices. Let's go ahead and open the poll, Jennifer, if we would. And if you would take maybe 30 seconds and cast your vote for the content for next month. Go ahead and vote now. Couple more people to vote. All right, let's go ahead and close the poll. And next month we will talk about managing after-tax qualified money. Thanks for your input. We're looking forward to next month as well. So let's talk today about the C Corporation tax advantage. And a lot of times when we talk to our business owner clients, we talk to them about tax planning, and there are certain kinds of advice that are persistent and relatively popular. And I think from my perspective, there are three things that we often talk to our business owner clients about. One thing that has always kind of been in style is the idea of forcing income into this year so that we don't have to worry about it next year. And we're hopeful that this year's tax rates will be lower than the tax rates we anticipate for next year. I suppose that's especially true now with some of the conversations that are going on in Washington. It is likely that personal and business income tax rates are going to go up, perhaps as soon as next year. And so it makes some sense if we're a business owner and we've got the ability to manage our income and the timing of our income, that we would put as much income as possible into this year. So that's a valid strategy and certainly something for our business owning clients, particularly those with profitable businesses, for them to anticipate and for them to plan around. Another kind of planning strategy is to plan for taking advantage of the 20% pass-through deduction that was part of the Tax Cut and Jobs Act. A lot of our business owners who own pass-through businesses, S corporations, LLCs, taxed as partnerships, sole proprietors, a lot of them are able to take advantage of the pass-through deduction, and it can substantially lower their income tax rates if they are. And so planning to take advantage of that is a valid strategy. Won't get into the nuances of that. It's just something that needs to be on our radar. And then a third thing that I think is not talked about that much, but should certainly be on the list of things to consider, is adding a C corporation to a successful entrepreneur's mix of companies. And that's what we're going to talk about today. And people, I think, get the wrong idea about C corporations. They think about, well, the C corporation has double taxation associated with it. And while that is kind of true, it's also kind of not. There's some tax management opportunities with adding a C corporation to the mix of companies that I want to highlight today. And I want you to be aware of as you talk with your business owning clients, if they don't have a C corporation in their mix of companies, perhaps it's something that they ought to think about. So let's talk about pass-through business versus C corporation and the relative taxation. And let's take a real example. Let's talk about Sally, who's the sole owner of an S corporation, a pass-through entity. Let's talk about Charlie, who's the sole owner of a C corporation. And let's go ahead and think about an example where the two of them each own substantially similar businesses, where they are kind of identical, except for the nature of how they're organized. Sally's S corporation, Charlie's a C corporation. And let's assume that they each have $1 million of profit this year in 2021. And let's also assume that Charlie and Sally are in the maximum personal income tax brackets. And let's also assume finally that Sally's business does not qualify for the 20% pass-through business tax deduction. Just to make the example kind of as clear as it can be. So each business has $1 million in profit in 2021. How does that work out tax-wise for each one of the businesses? Well, Sally's going to pay income tax on the $1 million of business profit at her personal income tax rate, which is, you know, if she's got other income, could be entirely 37% federal. And that leaves her $630,000 for her business to keep. $630,000 for her business to keep after she pays tax at a 37% federal rate. Let's ignore state rate for the purpose of this example. Well, what about Charlie and his business? Charlie pays corporate income tax on the $1 million of business profit at the corporate rate. And as part of the Tax Cut and Jobs Act, the corporate rate for C corporations was fixed at 21%. That means that his business is able to keep $790,000. Now, I'm a lawyer, not an accountant, but I do recognize that 790 grand that Charlie's business is able to keep is more than the 630 grand that Sally's business is able to keep. Now, that's not quite the end of the analysis, but it's a key point for our business owner clients to understand. If we're going to leave the money in the business, Charlie's business is able to keep more money in the business and use more money in the business than Sally's does. And so for that reason, it makes sense for Charlie to think about, or it makes sense for Charlie C Corporation to be structured the way that it is, because it's got more money than it can use. Let's talk about some of the advantages and disadvantages of pass-through versus C Corporation. So on Sally's side, if instead of making money, Sally's business is losing money, a business loss is something that Sally has the potential to take a personal tax deduction for. That's an advantage for Sally. So if we've got a business losing money, the pass-through entity is better. And another advantage for Sally is that even though she had less profit that the business was able to keep than Charlie was, that profit could be distributed out to Sally without any kind of later income tax result. And so that's an advantage of the pass-through entity. And it's the reason a lot of our clients have pass-through entities is they leak out all of the business profit pretty much right away. And if they do that, having a C corporation in the mix doesn't necessarily make sense. Now, the disadvantage to Sally of having the pass-through entity is that it can be an expensive organization structure if Sally is making more money than she needs to live on personally, right? So if she's not going to drain out all of the business money within a short time of the business taking a profit, it is expensive. And the math example that we looked at just a minute ago kind of confirms that. Now, from Charlie's perspective, having his C corporation makes a lot of sense because the C corporation tax rate is lower than his top personal rate. And personal rates, top rate's 37%, C corporation rate is 21%. The disadvantages are kind of the flip side of the advantages that Sally has. If Charlie's business is losing money, he doesn't get to deduct his business losses personally, and so that's a disadvantage. And another disadvantage that's kind of obvious is that getting money out of the business into Charlie's personal hands later on, if that's desired, can be a problem. That has tax consequences later on, no doubt about it. And that's where people who are worried about the double tax issue kind of get hung up. Well, not everybody wants to get money out of the business, and taking out money in terms of compensation later on may not be the smartest thing to do. But let's talk about that a little bit more. Let's talk about how Charlie might get money out of his business later on. First of all, he might pay himself extra, right? If he's working in the business, he can pay himself compensation. If he does pay himself compensation later on, his compensation is tax deductible for the business. And so while the C corporation may have saved money on an after-tax basis, if it uses that money later on to pay Charlie more, it will be deductible. And so the corporation gets the benefit of a tax deduction later on. Charlie also has to include his compensation as taxable later on, but he gets to pick which year that is. And so if he picks a year where maybe he has other high income tax deductions or losses from other businesses, he might be able to pick a year where it's advantageous for him to pay himself extra and perhaps pay a lower income tax rate. And so that flexibility allows Charlie a lot more control over the management of the amount and the timing of his income tax result in any particular year. Charlie could also pay himself a dividend later on. A dividend would not be tax deductible by the C corporation, so it would be paying after-tax money. But the dividend has the advantage for Charlie is, at least under current rules, is that dividends are taxed at more favorable rates than compensation. They're taxed at more favorable rates than ordinary income. Now, I know there are conversations in Washington to make that change for certain kinds of taxpayers, but at least right now, dividends are taxed at a lower rate than other income. And Charlie's got the ability to pick whichever year a dividend might be paid out if he's the sole owner of the company. So again, that provides Charlie some flexibility over the timing and the manner of income taxes. It's also possible for Charlie, if he's the sole owner of the business, to decide to pay himself a loan, a personal loan from the business. If the business loans Charlie money, if it's a real loan, it's not taxable. That's the good news. Charlie gets to use the money personally right away. Now, the loan's got to be repaid, and that's the downside. And of course, interest has to be repaid. But I guess a mitigating factor is that Charlie gets to decide which year the loan will be repaid, or perhaps forgiven by the business and treated either as a dividend or as compensation. So again, there's a lot of tax management potential in Charlie being able to use more money that he's able to keep in a C corporation because of the lower tax rate. And then a final strategy is that Charlie, if he's expanding his business and one day expects to sell to a third party, he might just leave the money in, reinvest it in the business, buy more equipment, expand into other markets. That money can be used for a lot of things inside the business. And even if it's after tax, there's more money available in the business than there would be in a pass-through entity. And so Charlie has a lot of choices with regard to getting money out. And for those of you on this call who work with retirees, it's not exactly the same kind of circumstance, but one of the key strategies when you're working with retirees is allowing them to have a bunch of tax buckets so that they've got the ability to pick and choose after retirement whether to take taxable income or tax-free income out to help manage their overall cash flow. Having a C corporation in the mix here is a similar idea for a successful entrepreneur. It allows for different tax buckets, different tax timings, different tax management strategies, and it is certainly something that our successful entrepreneurs need to consider. So what are the conclusions that we ought to take from today's webinar? First of all, I think adding a C corporation to the mix of companies is part of an overall tax management strategy for our successful entrepreneurs. They don't have to necessarily change their business entity from pass-through to C corporation, but there are lots of ways that C corporation can be added to the mix, and revenues can perhaps be shared between pass-through and C corporation entities so that the optimal tax strategy can be implemented. And that's the second point, right? A C corporation is part of an overall tax management strategy, and for most of our entrepreneurial clients, adding a C corporation to the mix rather than changing is a good sensible choice. And another thing that is a positive from the client's perspective as well as from our perspective is that we ought to add the client's CPA, client's business CPA, as part of the overall tax management conversation. The CPA is likely to be an advocate for adding a C corporation for our successful entrepreneur clients. And if it feels to the client like we are on the same team with the client's CPA, that makes everybody feel better and a lot more likely that our client is going to follow, our sensible recommendations for continuing to be successful from a financial perspective. And so those are the conclusions I think that we ought to take away from today's webinar. I'd like to thank you for joining us today, and I'll invite Jennifer to wrap us up. Jennifer?
Thanks, Linus, and thanks for joining us today. And join us next month on August 4th for Managing After-Tax Qualified Money. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. You can also email questions related to today's webinar to asktheexpert@advancedunderwriting.com. You can view this webinar as well as our past webinars on our YouTube channel. The information for the YouTube channel can be found on the screen right now. Please subscribe. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.